Welcome to Deloitte's Debriefs webcast series in Asia Pacific. Our webcast today is from our tax series and is titled Taxation of Cross-Border Head Office Business Branch Office Business Models. My name is Madhva Yatigiri and I am a partner based in Deloitte, India. I have the pleasure of hosting today's webcast. At the outset, we would like to apologize for the technical glitch that took place during our last week's webcast on this same topic. And we thank you once again for joining in and for the inconvenience that was caused last week. We have along with us today three presenters from Deloitte India, K. Bhaskar, Bhupendra Kothari, and Gaurav Bawala. All of us are tax partners. Bhaskar specializes in indirect taxes, Bhupendra in transfer pricing, and Gaurav in corporate taxes. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 50 minutes. Now let me give you an overview of the topics we will discuss. In the next 45 minutes, we would be covering overview of various head office to branch office business models, some of the case studies that we have seen on head office business office issues, key aspects to be considered while entering into arrangements between head office and branch offices, and impact on similar companies such as airlines, shipping, etc. With that, I would hand it over to Bhaskar to cover the indirect tax related challenges and aspects for considerations. Bhaskar, over to you.
Yeah, thanks, Madhav. Good morning, everyone. Today, we are going to discuss various head office, branch office transaction models prevalent across industries and the emerging tax issues around these models. Let's begin with the first model, which involves a head office business model wherein services are provided to the overseas customers. In this model, basically there are three key parties which are involved. One, the head office of a company which is located in India, the overseas branch of the Indian company, and the customer being the recipient of service which is located outside India. There are different variants to this model which we will discuss one by one in the ensuing slides. We'll now walk you through variant 1 of the business model. Here, the Indian company operates through a global delivery model, let's say by entering into a master services agreement with the overseas customer for providing services both on-site and offshore. Onshore services are provided by the overseas branch of the Indian HO, and following the provision of services, the Indian HO raises an invoice for the combined offshore and on-site services and reports the entire transaction as it exports in its GST filings. Upon receipt of money from by the Indian HO, upon receipt of consideration, the Indian HO also obtains the relevant foreign currency inward remittance certificate as a token of receipt of funds into country. XYZ Limited may then reimburse a portion of the payment to the foreign branch for the onshore services provided. This reimbursement is likely treated as income for the foreign branch. The portion of revenue attributable to the BO is subject to VAT and the corporate income tax of the relevant country. Correspondingly, the said amount transferred to the branch would be accounted as an expense in the books of accounts of the head office. In this model, the tax authorities contend that the reimbursement amount paid to the foreign branch is subject to GST, since they view it as a supply of service by the overseas branch to its Indian HO. Accordingly, on the said or the alleged import of services, there is a demand raised for payment of GST under reverse charge mechanism. The tax authorities majorly focus on the issue that any import of services by the head office shall be treated as services and shall be liable to GST, even though there is no consideration. Now let's move on to variant 2. Variant 2 of this model, and for ease of understanding, we have highlighted the subtle changes in the model from the variant 1 by way of the colored lines, wherein the red dotted lines represent the transactions which are now absent in the second variant, and the blue lines represent the newly introduced transactions. In this variant, the overseas BO enters into an agreement with the customer located outside India for providing services. The agreement includes both offshore and on-site services to the foreign customer. While the overseas branch is liable for the on-site services, with reference to offshore services, the branch approaches the head office in India. Under this variant, the remuneration shall be paid by the customer directly to the foreign branch office, and subsequently the branch reimburses the Indian HO for the cost incurred by the HO in providing the said offshore services. The portion of revenue attributable to the HO fails to qualify as an export of services, since the export of service definition excludes the supply of services by an Indian entity to establishments of a distinct person such as overseas branch. However, the transaction is exempted by way of a notification to this effect. Thus, the net effect being that the transaction is neither zero rated nor an export, but would still be exempt from GST. However, there are other implications to this. As you may be aware, under the GST law, a supplier of exempt supplies is required to reverse the input tax credit or forego input tax credit proportionate to the exempt supplies. Accordingly, the Indian HO will be required to reverse input tax credit in proportion to the exempted supply, and this in this variant would qualify as an exempt supply provided during this period, which includes supplies to the foreign branch offices. Now let's move on to the next variant. Under this variant, an agreement is entered into between the head office and the foreign customer for provision of onshore and offshore services, respectively. These agreements, either by way of an SOW or otherwise, clearly demarcate the nature and extent of supplies to be provided by the HO and BO, as also the consideration to be paid separately to the overseas branch office and the Indian head office. Furthermore, the branch office and the head office deliver the services directly to the customer outside India, and the revenue attributable to that portion of work done by the BO is subject to VAT and the corporate income tax of the relevant foreign country. Similarly, the revenue attributable to the portion of work executed by the HO is subject to GST and corporate income tax in India. In this variant, the consideration is usually paid separately to the HO and the BO by the clients. But there could be scenarios wherein the consideration may be paid entirely to the HO, which is subsequently repaid back to the BO by the HO. While this is merely a mode of settlement or distribution of consideration, we have seen tax authorities, especially in the erstwhile service tax regime, demanding tax on the share of consideration paid by the HO to the BO. However, from an IDT perspective, we find this variant, when coupled with the well-articulated agreement, to be the least litigative. This model also does not involve any ITC reversal, which was observed in variant 2, as a result of which lowers the cost to the company. So basically, under the first model and its variants, notices are issued around two key issues. One, can the reimbursement of expenses to foreign branch be considered as payment for services, by arguing that the Indian HO has subcontracted its services to its foreign branch, whether the foreign branches should be considered as separate and distinct legal entities for GST purposes. For a better understanding of these issues, let's have a look at the GST rule set or the provisions. Section 7 of the Central GST Act defines supply, which includes activities listed in Schedule 1, even though performed without any consideration. Schedule 1 of the CGST Act specifically covers the import of services from a related person or any establishment outside India in the course of business. To determine whether the aforesaid arrangement constitutes an import of services, there are three conditions which has to get satisfied. One, the supplier of services is located outside India. Two, the recipient is in India. Three, the place of supply is in India. In this case, the services provided by the branch has been performed outside India to the customer who is also located outside India. Therefore, the place of supply shall be outside India. In other words, the transactions does not fulfill the criteria for import. As a result, the reimbursement should not attract GST. However, the tax authorities argue that the branch has in fact provided services in the capacity of a subcontractor to the Indian HO, which ultimately bills the foreign customer. Hence, authorities contend that for the portion of services from the BO, the place of supply falls in India and that the transaction should be liable to get taxed in India. The matter is yet to be settled in the court of law, and it's a matter of time till we see the matter reaching several courts in India. Now let's just move on to certain clarificatory circulars on this topic. To address these concerns, the 53rd GST Council meeting, which was held in June 2024, recommended issuance of circulars to clarify issues pertaining to the valuation of these kind of transactions. And as you may know, circulars are official publications issued by the tax governing body that aim to clarify the ambiguity and also to bring uniformity in implementation of this act. While the circulars are binding on the revenue authority, it is not binding on the court or taxpayers. Hence, the taxpayers are at discretion to follow the circulars or clarification if it stands beneficial. I would also like to make a reference to Circular 210, which was issued in June 2024. As per this Circular 210, any value declared by the Indian entity as the value of import from its foreign establishment may be deemed to be the open market value, provided the Indian entity is eligible to recover full input tax credit. Interestingly, in such cases, even nil value may be deemed to be the open market value. As you may already be aware, a similar circular number 199/199 was issued in 2023 for domestic HOBO transactions. Circular 210 provides much needed relief to taxpayers, helping resolve ongoing litigations with reference to import of services from foreign affiliates by providing a better or a clearer framework for assessing tax liability on these transactions. However, in a scenario where the Indian HO is not eligible for recovery of full ITC for any reason, it would not be eligible to take benefit of the above clarification, and issues are bound to persist. The companies may also have a look at various judicial precedents under the erstwhile service tax regime on a similar issue. To conclude, we would like to highlight a few things. One, with respect to reimbursement of expenses, Although clarity has been provided in cases where the recipient of services is eligible to avail full input tax credit, the companies are advised to be cautious and aware of the reimbursement of expenses, especially how expenses reimbursed to foreign branches are classified in books of accounts, and mere classification of the overseas branch as a distinct person and expense reimbursement should not automatically imply the supply of services. The second important aspect is the documentation and compliance. The company should have a clear and well articulated documentation or an agreement for all transactions and reimbursements between the Indian HO and their foreign counterparts. Companies should critically analyze the transaction on aspects such as who should enter into a contract with the foreign company, whether the HO and the BOs should put in a place a MSA or an SOW for services rendered to customers, who should raise an invoice on the foreign customer and the valuation for the same, whether the Indian HO is eligible to avail or recover full input tax credit, and also consider the option of paying tax under reverse charge and recovering the tax paid as paid if it is only a timing issue as against a P&L issue. Some Indian businesses prefer the safer option of paying GST under reverse charge and taking credit of the same. As mentioned, it is only a timing difference rather than litigating the same with the tax authorities. In fact, as per Circular 211 issued in June 2024, companies who wish to remit GST under reverse charge towards imports for the past years can pay the tax today without affecting the right to avail eligible tax credits. And with respect to the constitution of a setup, branch versus legal entity, businesses may also need to analyze from a tax standpoint of view whether it is more beneficial for the Indian HO to establish foreign branches or subsidiaries, that is, separate legal entities. This distinction could significantly impact GST obligations and reversal of tax credits. And lastly, applicability of the CBICs, the Central Board of Indirect Tax and Customs clarificatory circulars. Analyze the applicability of clarificatory circulars, especially the circulars number which I voiced out, Circular 210, with reference to valuation of free supplies between the HO and BO, as discussed a short while ago. Over to you, Madam.
Thank you, Bhaskar, for providing your insights from an indirect tax perspective. That brings us to the first polling question of the day. And the question is on your screen, which is, do you think the recent circulars or the clarifications that are issued by the indirect tax governing body in India on head office, branch office transactions, and with respect to free of cost import of services provide sufficient clarity? The options are A, it's an yes, it does provide sufficient clarity. Option B, no, it does not provide the required clarity. And option C, it's somewhere, it's a maybe. And we would request all the participants to take up the poll. And Bhaskar, while we are waiting for the results and for the participants to take up the poll, I have a quick question based on what you just elaborated to all our participants. Which model do you think is the most ideal one from an indirect tax perspective, and of course, which has the least amount of challenges or the tax-related concerns?
Yeah, thanks, Madhav. Variant 3, which we said, have an agreement which clearly calls out the duties and responsibilities between the HO and the BO. If possible, have two different contracts, two different payment mechanisms, and two different sets of duties and responsibility. And more importantly, please focus on a robust documentation. Variant 3, Madhav, on a pointed basis. Variant 3 should work well. It's the least litigative model, coupled with whatever we said a short while ago.
Got it, Bhaskar. No, thanks for that. And we are getting the poll results, and if I can analyze the results, 62 or 60 odd percentage of the participants feel that, it's somewhere the answer is in between. It's not really a binary one. Maybe it does provide some bit of clarity, but seems like a lot, needs to be done from the indirect tax governing body. And about 20% feel that it does not provide required clarity, and the again in equivalent 20 odd percentage feel that yes, it does provide the required clarity. Thank you, participants, for taking the poll and for giving us your insights on this particular question. Now, moving on, I would request Bhupendra to come in and discuss some of the key considerations from a transfer pricing perspective.
Thank you, Madhav. Now, before we discuss the convergence point between TP and GST for each of the variants discussed by Bhaskar, let's step back and analyze the typical scenarios in which transferring regulations would be attracted. Now, firstly, let's analyze transactions between Indian HO and the foreign branch office. The Indian HO is a tax resident of India. The foreign branch office, being the permanent establishment of Indian HO, shall also be considered as a tax resident of India. So now, having said this, Section 92 very clearly defines the term international transaction, and which says the transaction between two associate enterprise where either or both of whom are non-residents. So as both Indian branch office and the head office both are tax residents of India, any transaction between Indian HO and foreign BO would be considered as an international transaction, shall not be subject to transfer pricing regulations in India, because both are tax resident in India. Having said that, there would be a requirement of transfer pricing regulation from the local perspective for the branch office. Now, let's look at the scenario 2, wherein there is a transaction between foreign HO and the Indian branch office. Now, Indian branch office will be considered non-resident of India, being a PE of a foreign headquarter. Accordingly, as per Section 92B, where there is a transition between two A's, either of both are non-resident, in this case both are non-residents, read with Section 92F, which clearly defines what enterprise would mean, which in this case would be a permanent establishment. The transaction would be subject to transfer pricing regulations of India. Now, having understood that where transfer pricing regulations would be applicable, let me now go through each of the variants which Bhaskar has discussed and see is there a convergence point between the TP and the GST regulations. Now, variant 1. As a set transaction between Indian HO and foreign BO, the local transfer regulations needs to be only looked from foreign BO perspective. In the set case, the Indian HO has an arrangement for subcontracting, which Bhaskar very clearly mentioned that the case which we are discussing, there is a arrangement of subcontracting wherein the Indian HO has subcontracted certain on-site delivery to the foreign branch office. In practice, when you have such arrangement, transfer pricing regulations or transfer pricing analysis would determine more or less a limited risk service provider and a cost plus arrangement with the markup, appropriate arm's length markup would be the right policy from transfer pricing perspective. Having said that, there's a risk on account of attribution that if foreign tax authority believes that the BO is doing much more than merely being a subcontractor as driven by the HO, they may attribute more to the foreign BO. It is important to note that in case where ITC credit is not available, the valuation would be at play, and hence there should be a convergence point between TP and GST as far as pricing or valuation of this transaction is concerned. At the minimum, it will help if TP documentation of a foreign BO, which is probably required as per the local rules, should not have any contradictory literature in terms of the transaction that India in GST filing is defining it as, let's say, a reimbursement, but the same taxpayer is defining this transaction and the role of BO as an entrepreneur or something else. So there should be consistency as far as possible. Now let's go to variant 2. In comparison to variant 1, variant 2 outrightly have far more risk, because the foreign branch office is at sort of getting into the contract both for on-site and offshore portion, and hence even though you characterize from GST purposes as a branch office as a subcontractor, highly likely that the foreign tax authority would come in from TP perspective and would recharacterize this as a lead entity or front-end entity, and accordingly would revise your profit or revenue to be attributed to the branch office. So you always run that risk, and accordingly the parity would not be there between the GST and the TP positions. Coming to variant 3, I think wherein the contracting is separately done by foreign branch office and Indian headquarter. In such a case, there is a clear demarcation of the nature and extent of services provided by HO and BO, along with a separate consideration remuneration for each of the parties. So from transparency perspective, variant 3 is the least litigative variant. Is more clear to implement, and probably the cleanest and the easiest to do a transfer pricing and accounting. Now, it is pertinent to note that for all the above variants, a well-articulated documentation, as Bhaskar emphasized on in a great way, has to be maintained. If possible, the parity between the documentation, the functions, assets, and risk which you have on ground in substance should be there in the documentation, and you should not have disparity between what you are filing for GST and what you're filing for transfer pricing. Is crucial to maintain such documentation. Madhav, I would like to hand it back to you with those comments.
Sure. Thanks, Bhupendra. And while it seems like Model 3 or the Variant 3 is the best suited from a transfer pricing perspective, as mentioned by Bhaskar as well, let's see if that really makes sense from corporate tax as well. I would invite Gaurav to throw light on direct tax related implications on each of these variants. Over to you, Gaurav.
Gaurav,
I
are
guess
you
it
on?
seems like maybe I would request Bhupendra if you could cover this aspect as well, please, till the time Gaurav's audio is rectified.
Sure, I'll do that. So, to refresh from direct tax perspective, let's understand the variants again. Under variant 1, the XYZ India, that is HO, holds the customer contract and realizes the revenue for both on-site and offshore services. Let's say for now, let's keep it INR 100. Out of such revenue, it remits INR 20 for expenses of the branch, which delivers the on-site services. Now, let's come to variant 2. The branch office holds the customer contract in this case and realizes the entire revenue for on-site and offshore services, again INR 100 in this case. Out of the above, it retains INR 20 for its expenses and remits the remaining 80 rupees back to XYZ HO. Under variant 3, as we discussed in transfer pricing as well, the HO and BO both holds customer contracts for the respective share of services, that is 80 rupees and 20 rupees. While these variants may have different connotations from a GST and a TP perspective, from a direct tax perspective, that is Income Tax Act 1961, XYZ India will be viewed as a single taxpayer and have one tax identification number, PAN number. XYZ India will be considered as a tax resident of India for the tax purposes and will be taxed on its global income, that is 100, after providing, of course, for a deduction of expenses incurred. This would include its income from the overseas branch as well. It will be taxed at the corporate tax rate applicable to it, likely 25.17%, as most corporates are choosing to be governed by this rate. At the same time, the overseas branch is likely to be treated as a PE of XYZ India in its jurisdiction, and be taxed at applicable rates. Let's say for US it is 21%. Again, as we already discussed in transfer pricing, the local transfer pricing rules will also govern likewise. Profits which are sought to be repatriated back to India will be subject to a branch remittance tax in the jurisdiction. As we took US as example, again 30% in that case. Different countries would have different rules for the same. The transactions between HO and BO, that is Indian HO and a foreign branch office, in this case will be eliminated in the process of computing the taxable income of XYZ India. As it may be evident, XYZ India has been doubly taxed in respect of income of its branch. So to this extent, to the extent there is double tax, it will be entitled for a FTC, foreign tax credit, of the taxes paid overseas on the doubly taxed income. Such credit would be available in India to the XYZ India, which is a head office. Now, certain principles that will need to be borne in mind in respect of the FTC are.
Sorry, am I audible?
Yeah, Gaurav, I've covered till the principles which we can talk about. Please go ahead.
Right. Yeah, thanks. And apologies again for the glitch. So, certain principles that will be need to be borne in mind in respect of these foreign tax credits are as follows. The quantum of credit that will be eligible would be to the extent of the India taxes that you would pay on such doubly taxed income. The credit will be available in India for the financial year in which such doubly taxed income has been offered to tax. And certain procedural and compliance requirements that one needs to be mindful of is to file a Form 67 along with the tax returns, and also keep in their records documentary evidences of having paid this tax. Another point that is relevant from a regulatory perspective is the permissibility of the Indian entity to send funds abroad at the time of setting up of the branch, as well as for its operational requirements. Now, under the Indian exchange control rules, an Indian company, that is XYZ here in our example, is permitted to hold foreign currency accounts for the purposes of meeting the requirements of its branch. And there are certain monetary thresholds that have been prescribed under the Indian exchange control rules, and they are as follows: that for setting up of the branch, an Indian entity can remit up to 15% of the average sales or turnover during the last 2 financial years, or 25% of its net worth, whichever is higher. And it would be 10% of the average sales or turnover of the last 2 years. With this, Madhav, I'd request you to continue the polling question, please.
Thank you, Gaurav. And this brings us to the next polling question on your screens, which is, are you currently paying GST under reverse charge mechanism on import of services or whatever are the transactions that are taking place between head office and branch office, irrespective of whichever variant that your company is following? Options are E, it's an yes, we are discharging GST. Option 2, no, we are not discharging GST. Option 3, not applicable in your case, in the absence of any such transactions. Would request participants to take up this poll, please. And given that we have heard Bhupendra and Gaurav on a direct taxes, Bhupendra, again, the question is, while Bhaskar did allude from a GST that variant 3 seems to be the best one, do you really think holistically from a transfer pricing, corporate taxes, and GST, variant 3 is the best chosen one?
No, that's a great question, Madhav. I think let's look at it more holistically, because taxpayer, ideally, even from corporate governance perspective, will not like to create multiple positions for the same transaction with different tax authorities, either within the country or across the countries, right? I mean, it's not the right practice. So I think variant 3 suits everyone, of course, with small tweaks here and there. And why so? I mean, let's look at even BEPS CBCR perspective, right, where different accounting policies may create more confusion in how do you record the jurisdictional revenues. Now, BEPS CBCR is also used for Pillar 2's primary calculation. So again, you don't want to upset the apples cart there by getting into variant 1, variant 2. So holistically, and by the way, Pillar 2 starts with your RPTs needs to be at arm's length again. So if there's something which creates confusion in terms of what is the right arm's length price or market price or whatever you call it under different either IDT or TP, short answer is variant 3 clearly is the winner or the least litigative from TP as well as looks like for direct taxes. Back to you.
Got it. Understand, Abhupendra. Thanks for that. And if I look at the poll results, more than 50% of them, it's not really applicable. Yeah, which we can understand, given that not every company will be operating under a head office, branch office, business model. And if I look at the remaining and it's a time where about 50% of the companies have been discharging applicable GST, and 50% of them are not discharging GST. I'm sure there are valid reasons, documentation, which they would have kept in place, in taking up whatever tax position that they have adopted. Okay, now we will get back to case study 2, and over to you, Bhaskar, to take us through the next case study.
Okay, thanks, Bhupendra, Gaurav, Madhav. Let's now move forward to discuss the next case study. In this scenario, again considering three parties: one, the foreign company XYZ Inc., the Indian branch of XYZ Inc., and the customer. Under this model, the foreign company XYZ Inc. may provide certain benefits at no cost to its Indian branches. These may include assets, and it may also include some bit of an IP, say for instance, the brand, the logos, the trademarks, and also in some cases, free of cost fixed assets, or other tangible and intangible resources. One such classic case is that of a foreign airline company or airline companies providing free of cost services to the branch or representational offices in India, with reference to the aircraft rental, aircraft maintenance, ground handling, crew salaries. What are the issues involved in this model? One, in this model, the Indian tax authorities have taken a position that despite the absence of consideration, transactions between the related parties, such as those between the foreign company and its Indian branch, qualify as supply from a GST law perspective. And this is for the same reason that the parties are related, and therefore under Schedule 1 of the CGST Act, transaction without consideration also attract GST. As a result, the revenue authorities has begun issuing show cause notices across various sectors, including shipping, airlines, and logistics. The investigative arm of GST, which is DGGI, has also began an investigation in October 23, probing claims that the Indian branches or the Indian branch offices of the foreign shipping companies and airlines have not paid GST under the reverse charge mechanism for services provided by their foreign head office. These notices contend that such arrangements may still constitute a taxable supply, with the valuation being a contentious issue, particularly when the recipient is not eligible for full input tax credit. As referred previously in our discussion with respect to circular number 210, for Indian establishments that are eligible for recovering full input tax credit, any value, including nil, may be accepted as the open market value. However, the ambiguity on valuation still remains for businesses that are not eligible to recover full input tax credit, and the tax authorities may dispute the valuation since the Indian entities are not eligible to recover full ITC. Until recently, the Indian branch offices of foreign airline companies were subject to intense scrutiny by tax authorities for valuation and taxation of free of cost supplies received from their overseas foreign head offices. Since Indian branch offices remitted GST in India on the passenger ticket sales, revenue authorities contended that the services ought to have been received by the BOs to render these output services. And as such, these services were deemed to have been imported from the foreign HO, and thus resulting in a demand for tax. Added to it was the fact that prior to October 2022, air cargo services were exempt from GST. Thus, the branch offices did not have the liberty of choosing any value as the deemed open market value. Since branch offices of foreign airlines are not legally required to maintain financial statements in India, there was lack of clarity on the classification and also the valuation of the services for demand of tax by the authorities. Recently, at the 54th GST Council meeting held a couple of weeks back, the GST Council did recommend exempting import of services by an Indian branch office of a foreign airline company if the same has been imported on free of cost basis. However, for a past period, the Council has recommended to regularize the same on an as is where is basis. The recommendation made in the Council meeting could provide significant relief to taxpayers, especially in the airline industry, and it represents a crucial step in facilitating the resolution of a long-standing dispute related to the past matters and potentially unlocking a substantial portion of tax dues currently tied up in the ongoing litigations. It also needs to be seen whether the government would invoke the newly introduced Section 11A in this regard. Just to highlight, Section 11A was introduced in the recent fiscal budget to empower the government to waive the recovery of GST either not levied or short levied due to a generally prevalent industry practice or a trade practice. However, we will have to wait for the fine print to see what is in store as far as the extent of relaxation is concerned. Also, it needs to be analyzed whether the relaxation would be extended to all FOC or free of cost import of services by the Indian branches of foreign banks, logistics and shipping companies. With that, we will move on to the direct tax impact on this case study. Over to you, Gaurav.
Yeah, thanks, Bhaskar. I'm audible again, right?
Yes.
Thanks. So under this case study, this is a flip side of the case study one. Now, under this example, the foreign company has a branch located in India. Now, generally under the Indian tax laws read with an applicable treaty, a branch of a foreign company will be regarded as a permanent establishment of the foreign company in India. And when a foreign company is said to have its PE in India, the profits attributable to the operations carried out by the PE will be taxed in India on net income basis. The income will be characterized as business income and will be taxed at the business rates that are applicable to a foreign company, which today is 38.22%, including applicable surcharge and cess. To give this by way of an example, if the head office or the branch office earns 120 and incurs an expense of 80, the net profit of 40 would be taxed in India on net income basis at 38%. A foreign tax credit is likely to be available in the home country of the foreign company, subject to satisfying the conditions that the home country may prescribe. Another relevant point that needs consideration is the tax on repatriation of profits from the India branch to the head office. Presently, the Indian tax laws does not provide for any branch remittance tax that would generally be applicable when the branch remits profits. With this, I would like to pass it on to Bhupender to discuss on the TP considerations with respect to this case study.
Thank you, Gaurav. Now, Section 92F very clearly says that and defines enterprise, and here permanent establishment is very much an enterprise for that purpose. So this transaction that is between the Indian branch office and the foreign HQ would be clearly subject to transferring regulations in India. Now, what does that mean? It clearly means that if there are any free of cost supplies by the HO to the Indian BO, it has to be valued appropriately for Indian purposes. It also depends on how we are remunerating India branch office. If India branch office is a cost plus, then they may not really worry too much about the valuation of the cost. If it's lower, if it's higher, is better for them. If it's lower, they would come into picture and see that is all the cost appropriately allocated to India or not. We have seen cases where brands have been used, which Bhaskar also mentioned, to the branch office. Now, it's a debatable issue, but AMP adjustments have been made on the branches by tribunal. So again, Indian tax authorities from transferring perspective will look at branch as a separate entity and attribute everything possible, but keep in mind the model which is there, the remuneration model, right? One thing which we can use for advantage here is the safe harbor provisions. Well, it is yet to come in the new avatar, but if we go by the old one, if there is an inward import of services in India. And if it's a low value rate services, I think cost plus 5 can be availed to for the ease or for the safe harbor purposes. So again, it is very critical for the Indian branch office of BO to have a very clear cut documentation on its functions, assets, and risk. In transfer pricing, risk is something you don't really attribute very well in advance because of ex ante concept. So in branch lacking that balance sheet size, it always looks up to the HO. You miss that in your analysis. So keep in mind that both functions, assets, and all the three things, functions, assets, and risk, would be critical to analyze for the attribution for Indian branch office. With that, back to you, Madhav.
Thanks. Thank you all. For throwing light on the second variant. With now, I will move on to the third, polling question of the day. And the question is, should the value of goods or services or any free of cost supplies between the related party transactions as per GST be harmonized with the transfer pricing regulations? The options are yes. Option number 2, no. Option number 3, maybe. And would request all the participants to take up this poll. And this is quite pertinent, especially given the fact that we would not be able to look at any of these transactions on a standalone basis, say only from an indirect tax perspective or only from a GST perspective, and hence we thought this would be relevant. And in the meanwhile, if I have to ask, Bhaskar, how do we really determine the value in respect of these free of cost supplies where the recipient is, say, not eligible for full input tax credit, while Circular 210 clarifies in other scenarios, but in a situation where the companies are not eligible, how should the valuation mechanisms work? What do you think, Bhaskar?
Yeah, so thanks, Bhupendra and Madhav. In terms of valuation, if the Indian companies are able to recover full input tax credit, no questions asked, it's a no-brainer, you can have any value. And with respect to those where they are not able to recover full input tax credit, the value should be at an open market value, or to borrow transfer pricing language, arm's length principle. If you are not able to determine open market value, you need to just look at the like comparables. And if it is not possible, you do not have a like comparables, then you need to do a cost plus 10%. If none of these things works, on a best judgment basis, Madhav. But the principle is open market value, and you can arrive at open market value by following the methods which I just voiced out.
So which means, Bhupendra, turning the question to you, when we arrive at such a value based on the GST provisions, do you think that mechanism meets the requirements under the transfer pricing regulations?
So, Madhav, this is always an interesting question whenever we talk to our inner tax colleagues, and the answer I would say is yes and no. Because transfer pricing probably has the lengthiest and the most detailed explanation of how to arrive at an arm's length price, unlike your SEBI LODR, Companies Act, or GST regulations for that matter, right? I mean, all these other regulations do talk about the transaction has to be at arm's length or as if it is between two third parties, but it is a transferring regulations who has plethora of experience, regulatory write-ups, and jurisprudence on how to look at a particular supply chain, look at a transaction, and do a arm's length, sort of remuneration or testing or allocation. So the short answer is it may work. At least cost plus 10 will not work for us because this is like a formulary apportionment or a fixed remuneration. But anything which justifies the free market value, where you get quotes from the market, wherein it is between two third parties without any biases, it works wonders for us. And I think vice versa.
Got it. Yes, I know it's never a simple, answer. Yes, there are nitty-gritties under each of the tax laws that needs to be, one needs to be wary of. If I look at the poll results, yes, more than 50% of them say that there needs to be some sort of a harmonization between a value that needs to be adopted for discharging GST as well as from a transfer pricing regulations. About 45% of them answer is maybe, and I would want to ignore 3% who say that there need not be any sort of harmonization. Yes, I guess we are all aligned. And now let me move on to the final case study in respect of what are the facts and the challenges that we have seen. And I would pass it on to you, Bhaskar, for providing us indirect tax perspective.
Yeah, thanks, Madhav. In this case study, a company headquartered in, say, state B has entered into an agreement for providing services with the customer located outside India. However, services under the agreement are provided by the HO as well as the branches that are located in different states of India. Accordingly, respective branches raise invoices for export of services on the foreign customer towards that portion of services rendered by them. Let's have a look at the issue involved here. The issue involved here is that the vendor is raising tax invoices from the respective states or GST IDs from where the services are rendered. However, the revenue authorities are of the view that since the agreement has been entered into by the vendor who is headquartered in state B, therefore the invoice should also be raised on the customer from the GST ID of state B. Further, the branch should in turn raise an invoice on state B or state B's GST ID rather than the foreign customer. So in short, the tax authorities deem that the work has been subcontracted to the branches by the head office. There exists a supply of service from the branch offices to the HO. Here, the fact is both HO and the branch office are in India, but in two different provinces or state, the customer being outside India. The tax authorities are now seeking to identify the location of the supplier basis the addresses of the contracting parties mentioned in the contracts rather than the location of the actual service provider. As a result, each place of business of the company registered under GST is being viewed as a separate entity by the tax authorities. The tax regulator, the CBIC, has issued a response to the frequently asked questions, particularly for the IT and IT-enabled services industry, on this scenario where supplies are made from multiple states of the supplier to a service recipient under a single contract. In this case, the regulator has observed that delivering services from various locations and integrated pricing for the contract as a whole is the norm in the IT and the IT-enabled services industry. Normally, an agreement is entered into with the recipient by one of the branches, let it be main branch or the head office. In such cases, the supply is visualized as consisting two distinct supplies. First, the different branches of the supplier located across different states are making the supply to the main branch. As a result, the branch is required to pay tax on the main branch, and the main branch can recover the tax credits thereon. The second supply is the main branch making a supply to the customer and should thus raise an export invoice on the foreign customer. While the above response to the FAQ pertains to the tech industry, we see the tax authorities drawing a similar conclusion in all cases where services are supplied from multiple registrations across different states. Alternatively, pursuant to the master services agreement that are agreed at the HO level, companies may choose to have documents such as branch level service agreement or SOWs under the MSA, identifying the specific branch from which the service is to be rendered or bifurcated of the value of services provided by each states. This is because dealing with tax authorities is not only about technical interpretation of legal provisions, but also what comes out in the documentation and contracting. Having robust documentation reduces the headroom for the tax authorities for litigations. Now I would like to just pass on to Gaurav to throw some light on the direct tax aspect of this scenario, for this scenario.
Thanks, Bhaskar. Now, while case studies 1 and 2 had either the head office or the branch office situated outside of India, this case study has both the head office as well as the branch situated in India. Under this case study, the head office in India has the MSA with a customer for the provision of services. However, the services may be provided by the head office itself or by the branch office in the respective states. Now, as per the slide, while the head office is in state B, the branch offices are in state A and C. And they may be providing these services to the customers outside of India under the same MSA. Now, the tax implications in this case can be divided into two scenarios. Scenario A, where both the head office as well as the branch offices are domestic tariff area units. That is to say that none of them are under any concessional tax regime where they will be entitled to claim a tax holiday with respect to the profits it earns. So while the GST law is administered state-wise, the income tax law is enforced at a central level, and the head office as well as the branch both will be viewed as one single taxpayer. The profits at the entity level will be taxed at the corporate tax rate of 25.17%. It is irrelevant from a direct tax perspective whether such income is earned by the head office or the branch, as long as both are in the domestic tariff area units. If the customer has withheld any taxes with respect to the payments it makes to the credit, and the Indian entity will claim those credits at the time of filing the tax return here in India. Scenario 2 is a case where the head office is a unit that is claiming certain tax holidays under the Indian tax laws. For example, it is situated in a special economic zone, and the branch offices are situated in a domestic tariff area units. That is, the head office is entitled to claim a tax holiday, while the branch offices are not entitled to claim any tax holidays. Now, by way of a background and a quick summary, under the Indian tax laws, an SEZ unit, that is a special economic zones unit, will be eligible to a tax holiday in the following manner. The first 5 years, they will be entitled to 100% of the profits, while the next 5 years, they will be entitled to 50% of profits. So where a taxpayer has units in both an SEZ and in a non-SEZ area, the taxpayer will be required to prepare segmental financial statements, and it will then be able to determine the profits that are eligible for a tax holiday. In the present case, let's assume that the total revenues at the entity level is 300 and the expenses are 240. And if one were to allocate them, the SEZ unit contributes 80% of the revenues, while the other two branch units contributes 10% each. The SEZ unit is in its third year of operations. So this is how the profit and loss account at while at the entity level, it'll be the total, but at the unit levels, it'll reflect like this. State B, being the head office, will have 240 as revenues. 80% of 240 expenses represents 192. So the profits that the SEZ unit earned is 48. And since it's established as an SEZ, it would be entitled to 100% of the tax holiday. Therefore, it will not pay any tax on the 48. Contrasting this with the branches, they will earn respectively 30 and 30 as revenues and 24 as expenses. So the profits of 6 corporate tax rate of 25.17%. So in this context, it's relevant to note that the profits that are attributable to a DTA unit vis-a-vis an SEZ unit can have an impact on the overall tax liability of the taxpayer. Accordingly, it would become relevant to ensure that such allocation is done on a reasonable basis and not with a view to concentrate profits in the SEZ unit to minimize the overall tax liability. In this context, it's relevant to note that there is a particular anti-abuse section under the Indian tax laws, which provides that to increase the taxable income of a taxpayer in a unit which is eligible for a tax holiday. these provisions are also embedded in the SEZ related sections. Accordingly, where one of the units is a DTA unit and the transactions between the head office and the branch office should be at an arm's length price to appropriately reflect profits between the SEZ and the non-SEZ unit. With this, I would request Bhupender to discuss on the transfer pricing aspects relating to this particular case study.
Thank you, Gaurav. And I think it's very clearly articulated by you. There would be certain instances where a transaction between an Indian HO and Indian BO, both domestic, would still be subject to arm's length price scrutiny, particularly when you have ATIAs, 10As, 115 BABs into consideration. One of the unit is in SEZ. You need to ensure that both the cost you allocate to those units and the overall profitability is not more than ordinary. And of course, if you are about 20 crore SDT or specified domestic transaction threshold, then it will be applicable. One more thing I would like to put here is a more of a holistic comment on this entire topic, that many times nowadays, for variety of different regulations, companies do have pre-approved pricing from their audit committee and board, either because of the corporate governance norms or SEBI LODR or Companies Act. So be mindful of this harmonization between the transfer pricing, the GST valuation, and your Companies Act and SEBI valuation, because if you take different stands, different documentation, different pricing, if you take a decision which will impact the book price, you should not go wrong on one to save one, go wrong on other regulation. So I think harmonization is a message which I would like to put at the end. Back to you, Madhav.
No, absolutely, and completely agree and aligned with that last point you made, Bhupendra. And with that, we'll come to the last polling question of the day, which is, do you or your company prepare transfer pricing documentation for your foreign branch office? Options are yes, option no, and depends on the audit and local requirements. Would request all the participants to take up this poll. And in the meanwhile, I have a last question for you, Bhaskar. In your view, do you think exempting any sort of a transaction taking place between head office and a branch office outside India clarifies or puts to rest all the issues being faced by the taxpayers, irrespective of whichever scenario they are operating under?
Obviously, if you just exempt something, exemption is not equivalent to a zero rating. But what would be appropriate is if the government can just pull out all the use cases and provide some clarity, that would be helpful. Exemption, as the name suggests, it may be tax exempt, but it is not a, it doesn't become a no cost kind of a thing. Exemption always is attached to a cost, and we did discuss cost in terms of either not able to recover certain input tax credits or reversing certain input tax credit, Madhav. But I think having clarificatory circulars covering the industries as we discussed, and also all the use cases, that would be helpful. Over to you, Madhav.
Thanks, Bhaskar, for that. And if I look at the poll results, yes, the answer is majority of them have mentioned that it depends on the audit and the local requirements. And otherwise, 37% of them are not really transfer pricing documentation. Okay, that unfortunately is all we have. Thank you, Bhaskar, Gaurav, and Bhupendra. And special thanks to all of you participants who were able to join us. We would like to encourage you to fill the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you find it late, please note that the content will be for viewing. If you feel others would benefit from the podcast, please share the webcast via share this icon or have them visit the Dbriefs website. We will respond to all the questions, including the in a couple of weeks. if any of other questions or comments later, please feel free to reach out either to me or our speakers. We would be more than happy to talk to you, and we would encourage you to join our next webcast, and details will be followed. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.
Thank you.